Finances are one of those uncomfortable areas of life that can add a lot of stress and anxiety. Today, I'm here with friend, founder, and CEO of Betterment, Jon Stein. Jon's going to help us understand a little bit more about investing and break down some of the myths. Thanks for joining me, Jon.
Yeah, thanks for having me.
So, investing can be complex. There's a lot of information out there. For the younger consumer, can you help us break down what are some of the biggest myths in the market about investing?
Yeah, investing is incredibly complicated, and I think it's kind of meant to be that way. Like, the industry has designed it to be complicated. If you get right down to it, it's not so bad, but there's a lot of misperceptions. To begin, there's this idea that maybe it's too early for some people to invest, or that you have to have a lot of money to invest. That's not the case. It's actually better for people to start investing really early. In fact, the earlier you do it, the better. You've got time on your side, and compound interest works magic over your lifetime. Even if you're paying down student debt, it's often a good idea to start putting money away. It's the habit that matters.
If you're paying down student debt, how do you recommend kind of balancing what you pay versus what you invest?
Yeah, the way we think about student debt is that if you're paying over about 5% on interest, you want to pay that down first. If it's less than that, you might as well just keep the debt, pay the minimum, and then put the rest of your money into an investment account. Another major myth is that risk is a bad thing, and you want to avoid all risk. So you can get no risk, and you can put your money in a bank account. It's just not going to grow, right? Like, you get no interest on that. And in fact, because of inflation, you're really losing money over time. The inflation is eating into your savings. Much better.
By just leaving it in a savings account.
By just putting it in a bank. By leaving it in a savings account, you're losing money.
And has that always been the case, or is that just in today's environment because you don't make the same returns on savings?
It's especially the case today because interest rates are zero. So you can invest that money, and there's risk when you invest, but over the long term, it's more likely that you'll earn more, even though there's volatility, even though things go up and down. So there's lots of ways to approach investing. We have, and it can be really complex if you make it so. But really, the asset allocation is probably one of the less important things. You want to be globally diversified. We do that for you. Other folks will just automatically create a portfolio for you.
I think a lot of folks probably don't even know what asset allocation means. So are you talking about like where you're putting your money,
What you invest in, right? So you're going to open an account and you're going to buy some kinds of, probably exchange traded funds is a very efficient way to do it. We do all that for you. We automate what you should buy. We manage it for you over time to reduce risk, to reduce your taxes, and get you a better return than you would if you just went out and tried to
do it yourself.
Buy things yourself.
And that's a good point, right? Because I think some people think they need to be an expert in it in order to invest, but it's probably more helpful to not have experts trying to move their money around all the time.
Well, this is one of the other myths, is that you want to be actively engaged in it, or that especially when there's, the market is volatile, you need to be actively engaged in your money. That is a path to ruin, right? This is a way.
I think I actually, when I opened my Betterment account, did check it every day. I'm like, it's not gambling.
It's okay to check it as long as you're not going in and actively moving things. We have lots of data, lots of research, not just us, but other firms have done the same kind of analysis. And the more people make changes, the worse their returns. So we have a feature that's unique to us, which is we'll show you what taxes you'll pay before you make a transaction. We call it Tax Impact Preview. And just showing people that, and everyone hates taxes, no one wants to pay taxes, means that 75% of people decide not to go through with the transaction because they're like, that seems bad.
So what's the time period? Like, how often should people be active? Because at some point you might need to move money.
It's based on your goals. So if your goals change, like in the way that we think about investing is based on, you're saving for retirement, you're saving for your kids' college. You might just be saving to have some, rainy day savings, right? To have money for something you want to buy later. Whenever those goals change, that's when you want to go and revisit things like, I'm ready to make a down payment on my house. Well, cash out that account, think about how much you're saving for retirement. I got a new job, I'm making more, now you can put away more money. So it's when your life changes, that's when you want to think about it. I think another myth is that expertise in the market somehow makes you better. People will look at somebody who's been investing for years and think, oh, that person must really know more than I do. If you look at all the data, people who actively manage stocks and are insiders aren't doing any better than anybody else who's just passively indexing. Sometimes people look at recent returns to compare different possible investments. It's like the worst thing you can do because it's not predictive of the future. So if you're looking at how did this fund perform in the last year, which is what they all tell you because like it's one number that they can
especially when you
sell.
do like your 401ks through your companies and things like that.
It's the worst, right? And they'll show, oh, here's the last 1 year, here's the last 5 years, here's the last 10 years. If any of those numbers matters, maybe the last 10 years, but not even that, because what matters is really the expected return. What are things going to do going forward? And none of those numbers tells you what's likely to happen going forward.
Why doesn't anyone share the expected return? They don't know it?
Because they don't know it, right? Because really the best thing you can do, if you look at all of history, if you look at the last 120 years of investing, the best thing you can do is diversify broadly, manage your taxes, manage your behavior. That's what we do. You can't call it any better than that. On average, people who try to buy whatever's hot right now underperform because they get it wrong more often than they get it right.
If someone wants to start investing tomorrow, what are the first 2 to 3 things that they need to make decisions on in order to take that step?
First, you want to think about how much can I save, and we can help you with that. But you want to try to put away. Obviously, if you're just starting out and you're just barely making ends meet, it's a little bit harder to put
but
away
even
a lot of money.
$10 is better than nothing.
$10, $100 a month can really add up to a lot. And remember, your money, if you invest it in a diversified market portfolio, might double just about every 10 years. So if you think about starting to save in your 20s, that's going to double 4 or 5 times by the time you need it for retirement, which means every dollar is like 20 to 40 bucks later in life.
Wow, that's awesome.
Yeah.
Okay, so figure out how much you want to save, and then in terms of choosing where you should invest, there's so much out there online. What's the easiest way to go about picking?
I mean, obviously, I'm biased. There's nothing better that you can do with your money than put it in a Betterment account, and we'll manage it for you. If you've got anywhere from $10 to $10 million, this is the best place for it.
Awesome. Great. Well, if you want to learn more about investing or you're ready to stash your money in the market, check out betterment.com, and I'll see you next time. Thanks.